our team of very talented professionals that all kind of come from capital markets and rating agency backgrounds.
All right, thank you. So with that, we'll kind of dive right into a brief background about what we do here. So first and foremost, our mission is to organize and structure the world's private financial data to become the leading tech-enabled arranger for private credit. So there's a lot to unpack there. We're going to do that over the next couple slides. But what's important to note is on the actual issuance side, we've actually structured 123 different investment products. That's ever since we were founded and launched in January of last year. We have about $500 million worth of assets available in the pipeline for us. And so that's a healthy amount of things that we can be structuring, and we are going to be doing that over the course of the next couple of months. Beyond that, our management team itself has about 100+ years of financial services experience. Obviously, myself and Prath have spent time at the banks. We also have various different team members who have come from other names that you hopefully recognize here. And we're also backed by several players in the industry. So that includes firms like Morgan Creek, which is a hedge fund, Argo, public insurance company, Nimble Ventures, which is a offshoot of Passport Capital, Revel Partners, Tuesday, Manat, our securitization counsel, et cetera. So really institutionally oriented cap table, and that's kind of led us towards doing what we do and how we are so successful today. The press has been covering us as well. So Forbes, TechCrunch, MarketWatch, Yahoo, et cetera. They've all been interested in the things that we were working on. So before we kind of really dive into the details, I wanted to give a little bit of a background on private credit. It is by far the fastest growing asset class across all of private capital markets, and private capital markets is pretty broad. It includes things like private equity, venture capital, real estate, infrastructure, et cetera. And private credit is sort of a catch-all bucket there that doesn't really quite fit as nicely into all those other ones. And so this includes things like small business lending, consumer loans. It's a pretty broad mix there. And there's a reason why it's grown so much. So in prior to 0809, the banks actually were driving a lot of that volume. And so they were lending out to small businesses, lending out to consumers. And then ever since the global financial crisis, they pared back, whether it's because of regulatory reasons or just want to adjust the risk they want to take on. And so that led to a bunch of non-bank lenders to come in. And they drove a lot of this increase in market size. At the same time, we're in a super low rate environment. We've been for the last few years. We're probably going to continue to be for the next few years. And so that's driving a lot of demand for these assets from pension funds, endowments, insurance companies, et cetera, because that's really the only place they can get yield these days. That's more on a consistent, reliable basis as part of their fixed income allocation. So all these non-bank lenders, who are they? They really actually are thousands of VC-backed companies from VCs out in San Francisco. So there are companies large and small addressing this private credit problem and giving debt capital to millions of underserved or non-served borrowers today. And hopefully these are some names that you'll recognize here. But the truth is most of them are in fact very, very small. So about 2/3 of the market is made up of sub $50 million EBITDA companies. And actually about 33% of the market is sub $5 million EBITDA. So naturally, VC-backed upstarts haven't been around a long time, don't have a lot of data around what they do, but if they did, they would actually be able to grow in a more scalable way. And so that's really where we come in the role that we play. So for us, like we mentioned, we are a leading tech-enabled arranger of private credit securitizations. We specialize in short duration, high yield, asset-based investment opportunities. A lot of our investments, actually most, if not all of them, are under 1 year. And many of them are actually just about 1 month or 3 months. And so you actually get inherent liquidity in these types of products by holding them through maturity and deciding whether you want to continue the investment a month later or 3 months later, or you want to kind of let it go and just let it mature and pull out the cash. In order to do what we do, we have to be pretty efficient on that front. And so we have a very scalable legal framework that takes the assets and conducts a true sale into our products. And that takes hours, not weeks. Normally, these types of securitizations are multi-week, multi-month processes that would not be that useful for a 1 month product. And so it only takes us a few hours to kind of make this happen. And we're probably one of the most diversified offerings and platforms on the market. We have various different asset types, ranging from small business lending to middle America, to power sports financing, to emerging market credit like Mexico and Colombia, all the way through things like mobile app factoring, Amazon merchant invoice factoring. So it's a really broad mix here, and it really is truly uncorrelated alpha. While the stock market is going crazy and no one has any idea where it's going to go, at the very least here, you are getting returns that are really not directly tied to the equity markets. And the theme of tonight is transparency. And so we provide the most transparency into asset level performance. And we'll show some examples of that later on. So to date, we launched the private beta, which is what Bettina had invested in early on in January of last year. We formally launched the platform live in July of last year. So we've been around about a year and a month or so formally. We've done 123 different investment products, like I mentioned, over $154 million worth of issuance volume on that front. Pretty diverse mix of investors. So we're talking about 50% have come from institutional investors, be they credit funds, family offices, et cetera. And the rest of them have come from retail investors. Since inception, even throughout COVID, our historical default rate is just 1.83%. And so we are far outpacing the market on that front. Credit to our structure, credit to our short duration, but all those things have led towards us being able to navigate COVID quite nicely, all things considered. Of that 154 million, we've paid back 121.9 of total principal, and we've paid out $2.9 million worth of interest, holding constant at about 11.5% APY, and we have a really, really sticky product. So 84% have invested in at least 2 or more of our offerings. And I believe we're up to 65% have invested in 4 or more. So I promise if you try it out, you'll probably stay with us, but we're here to show you why. So Prat, if you want to dive into the actual structure and how we work, that'd be fantastic.
Yep, absolutely. So in terms of structure, all of our short-term note programs are meant to provide non-dilutive growth capital to all these specialty finance lenders, as Nelson has mentioned. So we had to come up with a very efficient securitization kind of framework here. We basically borrowed a variety of elements from the institutional securitization market to make this happen. And we layered in a lot of technology to kind of, arrive at the same level of, or similar level of security, similar level of control that you would come to expect from any kind of, asset-based or asset-backed securitization. And we continue to improve upon that process. So in terms of the, sorry, is my screen flashing? Oh, okay, right. So in terms of the structure here, if you look at the right-hand side of this page, we set up, SPVs that are sitting with Cadence, and we manage these SPVs, and they face each one of our origination partners, and we have investors that are sitting on the other side of that SPV. So we structure notes that are issued by that SPV, and that SPV is purchasing assets and collateral from the originator, so that they are, all supported by the cash flows associated with that collateral, and ultimately making the debt service on the notes that are issued. And each one of these notes are designed to roll over in perpetuity. So they are short duration in nature. They range anywhere between, call it 1 month to 12 months. And we make it very easy for investors to be able to stay invested through each subsequent rollover. And at each point in time where they come up for maturity, this enables our originators to kind of right size and right structure each one of the notes. So say that their origination volume has been growing, they can kind of come back to the market and upsize the amount that's outstanding with the Cadence platform, to ensure that they have sufficient funding to continue their origination business, and at the same time kind of reprice based on kind of the level of demand that our market is providing. So we look to the next page. A few recent milestones that we're really proud about. We've crossed our 1-year mark recently. We've accepted over 6,000 investments, and that was only a few months ago. At this point, I think we're maybe about 1,000 more or more since then, just over the last few months. We recently and kind of earlier this year closed 100 million in total issuance volume, and we actually just surpassed 150 million just about a few days ago. And we've done, well over 100 offerings as well. As Nelson pointed out earlier, about 120 so far. From a current snapshot standpoint, across all of the notes that we've done, I think from a duration standpoint, we're relatively, well diversified. We try to focus on the 1 and the 3 month bucket, just because we know that that's where investors tend to have a lot more appetite versus kind of putting money out for longer. We've come to find out very early on that investors are looking for inherent liquidity with our products. And so they enjoy the fact that, it's only kind of 3 months, and, they can use it as a cash surrogate, view it as a kind of a cash substitute that's very high yielding. So we strive to kind of originate as much as we can at the shorter end of the duration spectrum. But naturally, originators always want, kind of longer term capital. So we're always kind of balancing that on our end. From a note position standpoint, as you can see, the vast majority is in a senior position. There are some subordinated notes on our platform that we clearly designate, and typically they come with higher yields, but for the most part, we want to stay in the senior part of the cap stack. And from a kind of geographic perspective, most of what we have is kind of US based or in developed markets. We do have a few international originators, one that's based in Mexico, another one that's based in Colombia. And we do plan to kind of continue to expand the international footprint, but at this time, we're mostly domestic. In terms of performance, as you can see, we have originated quite a bit of volume, and you can see that, for the most part, everything has performed relatively well. We do have a few notes that are in workout, as Nelson mentioned earlier, in terms of the default rate that all kind of occurred in the post-COVID environment. But the vast majority have performed well, and we haven't incurred any losses yet. In terms of issuance volume, this is as of the end of Q2. And so we were on track to do about 15 million a quarter when we started the year. And so kind of going into the COVID environment, we had to kind of scale back a little bit, understand where all the risks are across all the origination partners that we work with. So naturally, the volume came down in the month of March, but we certainly kind of picked that back up as we added a few new origination partners since the kind of beginning of Q2, and we've been averaging about 15 million since. We did end July with relatively lower volume, but in August we're actually set to have our record month of about 25 million in issuance. So certainly making up for lost time there. And our average APY kind of spiked at the beginning of kind of Q2, just as we were we were going out with rates to figure out what could actually clear the market, and we launched kind of a Dutch auction system that I'll get into in a little bit. That effectively kind of raised the yields across the platform for all the different offerings that we had. And then as investors kind of came back to the market, and as we kind of continued to increase the level of demand, naturally those rates have slowly started to come down. But on average, what's outstanding right now is still well north of 12%, which is kind of above where we have been historically as well. And in terms of notes outstanding by originator, we're always trying to kind of diversify the pool and offer that diversity to all of our investors. So we're striving to kind of make sure that each one of the colors here on the left-hand side of the screen are equal in nature. Of course, there's going to be some originators that just tend to grow quicker than others, that just are hitting their stride and happen to have higher origination volumes, and we're always just trying to match that demand and that supply. But we're always trying to strive to have an equal level of exposure available to all investors. And then in terms of asset classes, we are primarily facing kind of SMB lenders for the most part. We do have some consumer kind of exposure with a few different originators, and we are trying to kind of balance that equation. But frankly, a lot of the non-bank lenders that are out there face kind of merchants in a variety of different ways. So they come in different flavors. They may be kind of secured loans. They could be factored receivables, or something else that's a hybrid between those two. But naturally, I think we're always going to have kind of an outsized amount of supply kind of weighted towards SMBs. as I mentioned earlier, we are very proud of this future that we released earlier this year in the midst of kind of handling the post-COVID world. When volatility started kind of spiking and the public markets were kind of in disarray, and we were trying to figure out exactly where our kind of short-term notes could clear the market. We quickly rolled out a Dutch auction system, which is a system that isn't too dissimilar from kind of how the institutional markets operate. Typically there's a range that's put out there into the market, and you kind of gather indications of interest from a variety of different investors, and you end up kind of aggregating those orders, and you build a book, and then you kind of see where the price breaks are, and that's effectively, you go back to the originator and say, do you want the smaller deal at the tighter yield, or do you want the larger deal at the wider yield? And then we kind of launch that offering. So we make it really easy to kind of allow investors to have some say as to where we're launching notes. And so for every single one of our offerings, we go out there with an auction process and allow investors to effectively bid and put where they ultimately like to purchase any of these notes, depending on which yield that they indicate interest in. And we use those indications as a measure for what we should be going out there into the market at a specific yield. So investors get this every Wednesday or Thursday or so for offerings that are going to be closing in the next 2 weeks. And you can input exactly how much you'd like, and that helps us kind of determine the following rate that we launch with. We found this to be really successful. It's just a great way to engage the investor community, and also just kind of keep it very market based in terms of how we price each one of these deals. And then Nelson, do you want to walk through the surveillance reports?
Yeah, sure, absolutely. This is probably our most exciting initiative, in addition to the Dutch auction, in terms of bringing transparency. So this is something that you really won't see on any other platform, but we continue to add more originators every single week. Right now we have 14. We're about halfway there. We have a few more opening up their surveillance reports very shortly, but I'll show you exactly how that works here. So if we're to go back to our website, it's bringing real transparency to all of the various different originators that we have. So if you go onto our website, you can see it right here. You can go to our originators on the top left in the navigation. You'll see all different ones, different originators that we work with today. So I can just pick any one of these. Let's say Cherry. This is a California-based provider of point-of-sale financing. So you can view their profile, and you can view their actual reports on the right-hand side. So when you were to click into this, you'll see every single day we've been recording this activity here. And this is really what it looks like. So if I open that up, then we're over here. So you can see just the amount of clarity and granularity you can get out of all of this. But you can see the portfolio as a whole, how many days past due is it across current 1 to 15 days, 15 to 30 days. You can see how they've lent out by credit score. And so obviously a big concentration in the 600, 700 and the 700, 800 range, which is always great to see. The term of the loans that they have, outstanding balance based on the origination date that it came from. A lot of them are definitely from March, as to be expected here. And the balance by anticipated payoff date, how it's been paying versus kind of principal and interest. And yeah, so all of this is right here and available, and it's produced automatically every single day. And so you can actually track and trace the performance of your investment on a regular basis. So this is one element of it. But beyond that, if we were to go into the actual deal itself, this is our platform. When you log in, you see a list of all the various different deals and opportunities that are open. We'll go to that same deal with Cherry over here. And actually, sorry, got to go to a different one. This is actually in the process of closing, so it's not quite there yet. So let me just go to a different one here. So this is the older one that's maturing, and so it's a 1 month note. So you can go into the asset performance, and you'll see every single 957 different loans in this portfolio, what the actual loan amount is on average, total portfolio size, average term, and you can see which ones are performing and which ones are not. So this is all made available to you. That you can have a visibility and a look through into their entire portfolio. It's unprecedented. No other platform gives you that type of transparency. And so we feel that by providing this, investors can get a lot more comfortable around it. At the end of the day, we want to make sure that you're investing in products that you understand, that you actually are comfortable with, and that you can track and see how it's doing on a day-to-day basis. Normally in private credit, it's incredibly opaque. You actually can't see anything. You have no idea how it's performing. And it's kind of just a set it and forget it and pray that it actually performs the way you expect it to. This really kind of mitigates that. And so between the duration, the ability to have you set the price, the ability to see how it's performing, all those things are contributing towards creating as transparent as a platform as possible for private credit. So we can go back to the keynote here. Here we go. And yeah, perhaps we want to take them through some case studies of the lenders that we have on the platform.
Yeah, absolutely. So first up here, we have Wall Street Funding. They were one of our first originators on our platform. We chose to work with them because they're extremely data-driven. They are an originator of merchant cash advances based here in New York. They've been around for almost 10 years, and they've been kind of slowly increasing their origination capacity. But ultimately, they wanted to work with us to secure an alternative source of non-dilutive capital and help grow their portfolio. And since then, we've had a very successful program with them.
Oh, let me see.
Great steward pushing technology onto our.
Brad, you there?
Yeah, Brad.
Oh, okay.
Am I back?
I will.
We lost the audio. Yeah, we lost.
Can you hear
audio.
me now? Am I here still?
Yes.
Yeah.
Better.
Okay. Sorry about that. My Wi-Fi has been acting up today. Am I coming in now?
Yes.
Okay. All right. Perfect. So yeah, as I was saying, they were just great partners of ours that were really pushing, all the different interesting kind of transparency features that we wanted to roll out onto our platform. So they were the first to provide us real-time data. They were the first to provide us enough data to be able to produce surveillance reports as well. So just a great, fantastic partnership all around. But as you can see here, we've steadily increased the amount that we had outstanding with them since we began, mid last year or so, from 6 million outstanding to 12.5 million outstanding earlier this year. And we recently just closed our largest note with them at $10 million, which was the consolidation of a few different notes that they had outstanding. So recently we've been kind of undergoing a simplification process on the Cadence platform. Rather than kind of having multiple notes outstanding at any given time, we've been trying to consolidate them and build in kind of call options and different features so that originators don't need to necessarily have multiple notes outstanding, but rather manage one note, and we can kind of market that note a little bit more directly with investors so that everybody just has a better experience all around. But yeah, I mean, I think the MCA industry overall obviously has kind of gone through its fair share of pain during the post-COVID environment. But given their very data-driven underwriting, they were able to quickly kind of pivot to essential businesses, to merchants that are a bit larger, and really be able to navigate through this environment extremely well. So hats off to kind of the Wall Street Funding team here all around. Paul & VC was also one of our first originators, so we actually just crossed our 1-year anniversary working with them. They provide funding and kind of non-dilutive capital and help kind of app developers and game developers and provide them funding. And what they do is they actually install themselves onto the platforms in which those applications and game developers sell their product, and they collect the payments directly from Apple and Google. So effectively, the counterparty risk here is that those platforms don't pay, which is pretty pretty good quality credit from our perspective. So naturally, they've done very well. They've raised a lot of money on our platform. Their rates have tended to be on the lower side because of the kind of lower level of risk that's inherent with what who the counterparties are here and the credit quality overall. And then Asperia is an example of a non-US originator that we work with. They're based in Mexico, and they provide kind of lending or loans to small businesses throughout Mexico. The one unique advantage here is that they actually secure those loans by the real estate of the owners. So a good majority of the portfolio here are effectively real estate backed business loans. We started with them late last year. And again, I think the program's done really well. We've introduced a number of different notes for them and continue to extend the duration on these notes as well. So this is one program where, we don't think that, anything within the 3 months or under duration spectrum really works given the underlying asset class. So naturally, this is always going to be kind of, 6 months or longer versus someone like Apollon that, is in the business of originating much shorter duration assets. And, lastly, just in terms of kind of keeping up with what we're doing on our platform and all of our issuances, we do a weekly audio update that comes out every Friday, just to recap kind of the week's issuance activity and kind of how deals have been performing and, how they've been kind of working their way through the syndication process, as well as just kind of a general market overview. So you can sign up for that on Spotify or Apple Podcasts or wherever you get your podcasts. And then we also provide a monthly investor newsletter, and that goes out on the first business day of each month. That also recaps kind of all of our issuance activity, but more importantly provides a pipeline of all of the deals that will be coming out over the next month, so that investors can plan accordingly kind of which offerings they'd like to kind of shore up capital for and get involved with, to give everyone a bit more clarity around what's coming down the pike. And then we also do quarterly webinar updates for all of our investors. So at the end of each quarter, Nelson and I kind of get on a similar format like this, and go through kind of all of the kind of salient updates over the prior quarter. And we also open it up for Q&A as well for folks to kind of ask any type of questions, and we try to make it as interactive as possible. So that's every quarter.
Yeah, so key takeaways here. Obviously, we have some of the most unique and diversified investment products on the market. You really can't get them anywhere else. And with your ability to choose yourself how far you want to diversify and where you want to allocate to in the sectors that you like personally. The minimums are really low to start, so it really is designed to help you kind of try it out and get comfortable with the products. It's $500. And so you can find a 1 month product that we have, put $500 in, and then come back and see if it actually is real and you got your money back. We promise you will. And beyond that, you actually have no fees at all. So it really doesn't hurt at all to try it out and see how it goes. But we think that coupled with the transparency provides a really unique perspective and alternative to the other platforms that are on the market. So with that, we can take any questions.
Hey guys, excellent presentation, Nelson and Prath. Folks, if you have a question, feel free to either chat it over in the chat box, or you can unmute yourself and ask the questions. Actually, Nelson and Prath, I do have a question. So how long from inception to where you were able to get your first originator on the platform, like how long did it take you to where there was this idea in your head when you were at Merrill or wherever to where you got it, launched? How long did that take?
That was a fun exercise. Prath, you and I can both relate to this. So we were founded in mid 2018 with an idea to build something like this, just with a different angle. It's kind of its own little angle to it. And we just wanted one originator to believe in us, basically. We had to find somebody who actually understood that, yeah, we will get you $250,000 from some family office that we know, we promise, but you got to give us a shot here. And so we bounced around with a lot of different lenders just to see which one would be the right fit. And we happened to settle on Amazon Merchant Working Capital Financing. It was an introduction through the lead investor of our first round of financing, who had invested in a hedge fund, which the hedge fund had an equity stake in this originator. So it was 6 degrees of separation there to get to these guys. But they were the only ones that actually passed our, what was back then, very rigorous underwriting standards, which has become much more rigorous since then. But they've done really well. And so, yeah, that was the first originator. It took a lot of work, about 6 months to get them off the ground. First note launched on January 2nd, I want to say, of 2019 in the private beta for $250,000. Myself, Prath, and our parents were some of the first investors in that note just to get it off the ground. I think Bettina came not long after that in some of those sellers funding notes. Yeah, the rest is history. So yeah, 6 months in terms of really kind of trying to get someone to believe in what we were doing.
Okay. And I think Roland has a question. Prath, if you want to take a shot at, look at your chat box, and I think Roland has a question.
Sure, let me just take a look here. Sure. So the question is, how much does Cadence take on each of the deals? So our fee structure is, completely geared towards the originator. So investors don't pay any fees to, be able to invest in any of the notes that we offer. So everything is kind of net of fees as advertised. On the originator side, what we do is we charge, about a 1% annualized fee on every dollar raised on the Cadence platform that we take out as almost kind of like an underwriting fee that we take out of the proceeds before we send them, kind of the wire after we close each deal. And then we also charge them roughly 1% as a platform fee, which is what we call kind of a SaaS fee, to use the Cadence Sync software. So we've developed a lot of technology, as you can imagine, and we've kind of developed a software application that faces originators to help administer the programs that we have outstanding, the documentation, kind of all the workflow, all the compliance aspects of each one of the programs. So in order to maintain that, develop that, continue to fund our kind of technology business, the originators kind of chip in that way too. So all in all, it's roughly 2% annualized on every dollar that originators raise on our platform is kind of how we get paid.
Got it. Joe is asking, can you dwell a little bit more on the risk involved to the investors? Because this is relatively new. So what levels of underwriting are performed? And I'm assuming that for each type of a sponsor that you bring on board, you have to have some underlying knowledge of their business models and the risk mitigation and so on. So can you chat a little bit about that?
Yeah, absolutely. So if you divide kind of the universe up into kind of consumer and SMB, that's kind of how we developed our risk models internally. And obviously each originator has their own nuances as to how they face specific type of borrowers in each one of those segments. So what we do from a due diligence standpoint and underwriting standpoint is we take a look at, how they've performed historically. So that's number one. We take a look at, as far back as they go, preferably over a multi-year period, what the default rates have been, what the loss rates have been, collection rates, run vintage analyses to understand exactly, how these portfolios have performed. And then we also take a look at the health of the originator themselves, because obviously a lot of these lenders are self-servicing. They don't work with external servicers. So we have to make sure that, the cash flows that are being generated from the assets can actually, continue to be serviced, and the borrowers can continue to be serviced as well. So we take kind of a, corporate level view as well as a portfolio level view. And then we think about, how best to layer in credit enhancements into our node structures to help mitigate against future losses that are expected, based on that prior performance. So for example, if an originator was averaging about 5% of, defaults over the last 3 years, there's a reasonable assumption that they'll continue, based on certain stress tests that we perform, that percentage may go up or down a little bit going forward. But reasonably, you can expect that they'll continue that pace, especially if it's a well-diversified portfolio and their underwriting standards continue to, be consistent going forward. So we'll take that 5% default rate and we'll think about how best to cover that going forward via an over-collateralization or like a first loss mechanism in our notes. So typically we always want a multiple of kind of what they've experienced in losses historically, as a cushion against future losses. So all of our notes come with some level of first loss protection, and you can kind of see that in the comps table that Nelson just brought up here. Towards the bottom, you'll see that there's kind of a coverage metric, as well as kind of the default rates associated with each originator, and kind of what that translates to in terms of, loss absorption or cushion going forward. And so that's really the credit enhancement that we rely on. But obviously, we do a lot of ongoing monitoring as well of the portfolio, as you can see from the surveillance reports. We do a lot of ongoing monitoring of the originator at the corporate level as well through quarterly compliance certificates and reviews on an annual basis to make sure that, again, the portfolio is performing well and the originator is in good financial health.
Mhm. Got it.
Prath?
Thanks.
Hey, Bobby, can I jump in with a question? Hey, Prath and
Sure.
Nelson, I'm trying to, so I was a little confused about the last, that last answer that you gave. So when you say we, I guess I was operating under the assumption that Cadence is sort of just a facilitator. There's, there's a bunch of originators that are looking for capital, and then the investors are on the other side. But it seems like you also somewhat add value to, the credit opportunities. So then it gets a little bit muddy, right? So then if something defaults, does the investor kind of hit it up with Cadence, or they hit it up with the originator?
Yeah, that's a fantastic question. So to answer your last part of that, you'd be hitting it up with Cadence. Cadence is actually the issuer of all of the notes. And the structure here is that we set up these SPVs that we actively manage on our end. They are all part of a series LLC structure that sits in Delaware. So for every offering, there is a dedicated SPV that is purchasing assets from the originator through a participation agreement. And then that SPV is issuing the notes to investors. So what investors are buying at the end of the day is a Cadence note. A Cadence note that is backed by or based on assets that are sitting at the SPV that Cadence has purchased from the originator. So we're positioning all the originators as, effectively being the sponsor of each one of the notes, because they're in the business of originating the assets, they're in the business of continuing to service them. We want to kind of funnel as much information over to the investors as possible, through all of the technology that we've built and the reporting and what have you. But at the end of the day, investors are buying Cadence notes, so you have that added advantage of Cadence continuously monitoring, each one of the originators that we work with, on a consistent basis, as well as that initial underwriting, for the benefit of investors.
Gotcha. Okay, thanks.
Mm-hmm.
All right, we have a question from Raj. Can Nelson Pratt talk about the risk to the investment and what is the minimum? But I think on the risk, maybe you can, I know you've touched a lot on the risk underwriting process and so on. And, but maybe you can, if there's something you haven't touched on as far as what the investors should be aware of as they do their own due diligence, what should they be aware of, or what should they be looking out for?
Yeah, absolutely. So for every one of our offerings, we put together a very detailed private placement memorandum that actually outlines kind of the specific risks that are associated with each deal, with each originator, and typically with that specific asset class that the originator is in as well. So I would highly recommend looking at the PPMs that are made available to any prospective investor for any deal. And you can kind of scroll through that document. You can go to the risk factor section and take a look at each one. But outside of that, we also have our deal pages that kind of summarize some of the risks, but obviously you should always go to the PPM to see all of them. But you can see some of the risk factors there and the mitigants. And I think from an overall underwriting perspective, I mean, we have our rubric and we are going to follow it as closely as we can for every single offering. And it's obviously, in our best intention here to only put out the highest quality deals for investors to participate in, because we have a reputation on the line. And frankly, our kind of longer term business model here is that we're trying to find really high quality, really high growth non-bank lenders that are very early stage, and help them grow their portfolio so that we can ultimately bring them to the institutional market. So we're kind of taking a VC approach when it comes to, which originators that we want to select. Ones that have, kind of high growth potential are the ones that we want to bring on the platform. And so, we have kind of a vested interest to make sure that the originators themselves, the portfolios that are here are, of the highest quality, because, ultimately we want to be able to, bring them to the institutional market. So everything on the retail platform is, highly vetted by us. But again, to answer your question, I think the deal pages provide a good level of information. The PPMs provide even further information. But if you ever have any questions with anything, we have great customer service, great customer support available, and you can always reach out to me or any of the capital markets team members for any specific questions.
Got it. All right, great. One really interesting question from Dawn. I'll just repeat it. What is the latest update with the Ethereum contracts? I was informed that the digital ledger was put on hold due to the increased price of ETH.
Yeah, I'm happy to answer that. So if you've been following cryptocurrency for the last, call it like 2 months or so, obviously they had a bit of a run up, but what contributed to that run up, or the byproduct of that run up, means that just fees in general across the board are very, very expensive. So we're looking to basically find the right time to kind of retroactively create these digital securities. But at the end of the day, the actual legally binding, especially in the United States, contract for making these investments is with the signature and the subscription agreement that an investor would sign. It's definitely not on the digital asset side of it, because it's not going to hold up in the court of law. But what we've been doing with the digital asset is really kind of pushing for more transparency on the cap table front. So right now, for a lot of these historical issuances that we had, an investor could go in and click through and see basically everyone who invested in that note and how much they invested for. They just didn't know, they wouldn't know who it is. So that was a nice added benefit. But as of right now, there's no point, or it doesn't make financial sense to be doing it, because it's costing us several $1,000s per transaction. And as Prath mentioned, we're not making a ton on this anyway. We make most of our fees when they're out on the institutional markets. And so it just didn't make, at that point, with the way prices are now, it didn't make a ton of financial sense for us to keep doing that. But we're also exploring potentially other protocols, not Ethereum, to be able to continue to do this in a much more cost-effective way. There's several others out there that are equally as good, equally as transparent. And if they're a good fit, then we'll move over there, and then investors can continue to get that benefit.
Got it. Excellent question. And then Nelson or Prath, what about currency? Like you mentioned, you're in some of the Latin American countries, and you have the currency fluctuation, let's say with the Mexican peso. How do you kind of resolve for that?
Yeah, absolutely. So the FX risks involved with the international originators that we work with, the currency risk is completely borne by the originator. So in many instances, they are hedging on their end. There is no hedging kind of mechanism within our note structures. We are kind of participating, in the assets on a dollar-denominated basis. On the investor perspective, it's dollars in, dollars out. On the originator's perspective, it's local currency in and dollars to pay us. So really, they are the ones that are responsible for hedging their own exposure. Typically, they will on their end, and it's kind of a lower cost to do so on their end, because the debt obligations here are relatively shorter term. So they're not hedging out to like 5 or 10 years or anything. So it tends to be relatively cost effective on their end. But again, that's a cost that the originators are bearing.
Got it.
I got a couple questions. So generally these notes, it would be not liquid, right, until maturity, I would assume. And then the second question is, did you say, Prath, that you guys are going to offer a platform like this also to the institution, or did I mishear that? And if you are offering a platform, or like something to the institutions, what would the deals look like on that institutional platform, versus the retail deals?
Yeah, absolutely. So the institutional side of our business is twofold, really. So right now on the retail platform, we do have a number of institutional investors. So actually, 50% of the capital that's come through into all the deals that we've talked about tonight have come from family offices, private credit funds, and the like. But we are also, we also do have kind of an institutional kind of arm of our business where we're bringing first-time ABS issuers to the market, and we're also kind of working with existing originators on our retail platform and kind of helping them secure larger credit facilities and kind of next level financing given their stage of growth and where they are in their life cycle. Our intent here actually going forward, and Nelson, I'm sure you can touch on this, is kind of, blending those two worlds a bit. There's a lot of instances where, there's deal flow that may not necessarily fit nicely with our retail platform because of duration or, just kind of size or otherwise. But they may not be a great fit for kind of going after a $50 million credit facility either, and trying to sell that to, an insurance company. So, given our position in the market, we continue to see a lot of deal flow across the landscape. And so we have been exploring kind of, rolling out with a prime platform. And Nelson, I don't know if you want to touch on that a little bit.
Yeah, so the minimums on Prime are going to be about $1 million in terms of assets on that are kind of deployed or put to work. But with that, you'll be able to basically have a little bit of a different approach or flavor to this. So you'll see everything that we can do, right? For example, some of these lenders are willing to take bespoke notes with just one investor. The investor can set the price, they can set the duration, they can set all these different things that they want, and then we can go out to an originator if they like them and say, if we have $1 million or $2 million of this, would you take it? And if they say yes, then we'll structure a bespoke note for that one specific investor. And so if it's at a dollar value that's high enough, we can make that available. Beyond that, like what Prath was mentioning, there's a lot of these kind of middle market deals that are just hard to close on the retail side because they're just a little bit too big. They're going to be in the $15, $20, $25 million range. And then there's also just way too small for a true institutional investor. So there's a bunch of family offices that might be interested in that. And we offer that on the Prime platform as well. So it's a bit of a different kind of slots right in the middle for the investor who wants to put more capital to work. We can make it a even more white glove experience for them by doing it very, very bespoke. But your question earlier on sort of what happens when you hold through maturity. Yes, so there's inherent liquidity by you holding it all the way to the end and deciding what you want to do. And we try and give you that liquidity through 1 month, 3 month, 6 month investments. So, if you know that you need cash coming up, but you still want to earn some interest, then go after only the 1 month stuff. But if you know that you have 50 to 100 grand that is going to not be needed for 6 to 9 months, then you can do that as well. But we also have different pay down structures that might be beneficial, such as, some of them actually pay out principal and interest on an amortizing basis every single month. So some of those might be interesting too. So these are all different types of structures and things that we've built in to kind of give the investors as much optionality as possible. But when about 2 weeks before the deal is ready to mature, you'll see a little button underneath the investment that says, do you want to roll it over? And so at that point, you as an investor can decide, I want to roll over all my principal and interest. I want to roll over above principal, interest, and cash. I want to roll over half of what I originally invested, whatever it is, it's your choice. You have the first look to decide what you want. And then you could also say, I just want to take all the money out. And you just let it mature and don't click that button. So again, more optionality, more flexibility. That's the name of the game here that we can provide.
Got it.
Are you guys, sorry, Bobby, one quick follow-up question. So are you guys planning on creating a secondary market? That's what I meant by the liquidity.
Yeah, so these are Reg D securities that naturally have a 1-year lockup. The ones that, for example, if you were to do it on a Reg S basis, which we do have a Cayman vehicle available, then those technically aren't subject to lockups. And so in which case, yeah, we could if there's a buyer for it, then we can, and if you know who wants to buy it, then we're happy to facilitate that trade. We've done that a couple times already. But in terms of a full-fledged secondary market that has like full-on trading built into it, the sizes of these investments don't make a ton of sense for that, especially since they're so short. If we start to structure like 6-year, 7-year, 10-year products, then yeah, I'd say sure, we can definitely do something like that. But the people who are looking for that tend to be institutions, and they tend to be larger deals, in which case those would naturally have some sort of secondary built into it, but it's going to be traded on the institutional markets and not on the retail side.
Roland, anything else?
No, I'm good. Thanks.
Okay.
Go ahead.
I have a couple of follow-up questions from folks. One is, your technology, relatively new. Who is it disrupting? Who are you affecting? And then who are your allies? Like, which space are you disrupting, and then which space are you helping?
Yeah, so it's a great question. I'd like to think that we're allies with everybody. And so, we're here really to try and make the market more efficient. If you think about it, the buy side of that $1 trillion market, which we didn't show this slide, but there's about 400 billion sitting in cash waiting to find these opportunities, right? So they literally cannot find them because 85% of their time is being spent on sourcing and diligencing deals and not actually spent on investing. And the deals they're getting, about 40% of them are coming from direct relationships. It's just people that they know. So it's downright impossible to kind of put $400 billion to work through direct relationships. It's crazy. So what we're disrupting truly is trying to create a market that looks and feels more like the public debt markets, much more efficient. We don't set the price, the market sets the price. They can do its own price discovery. There's more data to be able to diligence faster. There's standardization. Bloomberg, for example, you know what you're going to get when you search up an equity ticker. You know what it's going to look like, what historical information you can reference. There's none of that in private credit. And so it's been opaque for decades. And it's thrived despite its opacity, not because of its opacity. And so our job is to kind of bring real transparency there through all the things that we're doing here today to be able to actually make that market significantly more efficient. On the lender side, they love us, right? Like they know that our incentives are aligned with them. We are the cheapest, most flexible cost of capital on the market for them, because the alternative for them is to go to a single investor or multiple investors they have to manage themselves, which is an absolute pain. And it's going to be very, very expensive. And so we have the ability to kind of use the crowd to be able to bring that down for them. But at the same time, the crowd as a retail investor gets the benefit of just being able to access this stuff, which normally would never, ever be possible. Traditionally, these are like 200K minimums, 500K minimums, just even get into these opportunities. And so we're really kind of lowering the bar there to be able to provide that diversification. And even the banks who you think, well, technically aren't you a bank in a lot of ways because they do this stuff on a bigger basis. And the truth is, yeah, they do, but we're not here to compete with them. At the end of the day, they have a desire to go down market. They need to do smaller deals if they could actually have the technology to make it more efficient, because they want that relationship. They know that this lender who needs 25 million right now is going to become $150 million one down the line, which is going to be one of our clients later. So I'd rather do something with them and be able to help them at their earlier stage so that they're actually going to work with me in the future, and I can lock in that relationship and they don't go anywhere else. So there's really nobody that we're antagonizing here. We're simply helping people find each other and make friends.
Got it. Excellent. One question from Joe. Is your service platform regulated by the SEC? If not, what regulations are you operating under?
Yeah, sure. So we are not a broker dealer, and we don't have to be. So like to Roland's question earlier, I think we are issuing our own securities, right? So when you have a issuer exemption, you don't have to be a broker dealer at the end of the day. We're also not an investment advisor, so we're not recommending you go into any of these investments. We're simply presenting them to you, and it's your choice as to what you want to do with that or not. All of our investments, like what Prath mentioned earlier, fall under Reg D. And so these are private securities sold to investors who are accredited, and we verify that. And so, this is something that the SEC is well aware of. There are plenty of other platforms like us out there. We just like to think we have a better mousetrap with all the different types of benefits that we offer that no one else does.
Got it. And I think one last question from Raj. What's the minimum, and do you have to be accredited to get started, and what's the minimum?
Sure. You do have to be accredited to get started. It's self-accredited. And so when you sign up, you have to say that you are an accredited investor. When you sign the subscription agreement, you have to say that you are an accredited investor and why, and you can check off the boxes that apply to you. But we did set the minimum to be very, very low. So it is $500. And the reason for that is because it gives investors the opportunity to try it out, to get comfortable with us, to kind of learn how the platform works and get their feet underneath them before committing more money. And so, you're more than welcome to put in $500 into a 1-month investment, get about $5 worth of interest after a month, and then see if it comes back, and you can deposit it, you can withdraw it, you can do whatever you want. And then from there, you can get more comfortable with it. So, there's one investor on our platform who wants the ultimate in diversification, has put $500 in every single deal we've ever done. I think he's at 60 now at this point. So good for him. That's one strategy for sure. But there's other people who obviously like certain sectors and they double down on those after they've gotten comfortable with it. So, pick your style. We're always welcome to it.
Got it. I don't have any other questions, but excellent presentation. Roland, any last parting thoughts?
No, thank you guys. Great presentation, and appreciate you guys taking the time.
Yeah.
All right. Yeah, thanks so much. So, you can always reach out to us. I'm at nelson@withcadence.io. Prath is at prath@withcadence.io. We make it very easy. And then obviously, like you mentioned earlier, our customer success team would be happy to talk to any of you if you have any questions around the process, how it works, how we underwrite. They're just here at hello@withcadence.io.
Excellent. Very good. Hey guys, thank you for making the time. Bettina, thanks for making the connection, and let's keep in touch and hope to see everybody in about a month. We'll meet again. We'll have another company presenting, but look forward to seeing you online. Thank you guys.
Thanks so much.
Absolutely. Thank you, everybody. Really
Thanks for having
appreciate
us. Take care.
it. Thank you.
Bye.
Take care.